would like to welcome everybody. We're expecting over 100 attendees, hence why we had to send last minute details to switch over to a webinar. So this is what happens when you invite two people of this caliber to come and speak to this group. So thank you both for talking to our alumni group. For those that don't know me, I am Adriana Munoz. I'm the president of the Executive Ed Alumni Club. And this is our first educational event, so I'm pretty excited about it. On top is my team, the education team, Luca, Vinar, Manuel, and Tamam, who's somewhere there. And yeah, we're looking forward to welcoming you guys. And I just want to go through some housekeeping. We are going to leave ample room at the end for some questions. You can type them in the Q&A. If it's something relevant to what we are discussing at the time, I will moderate and intervene in the discussion. If not, we will leave them towards the end. And also want to let you know that this is being recorded if it didn't notify you when you entered the webinar. So without further ado, I'm going to introduce David Wessels, Professor of Finance and the Program Director for Executive Education at the Wharton School. Professor Wessels, he wants me to call him David, but I can't. I've taken several courses with him. I can't call him, David. I'm going to try. He's highly regarded by his students. He's actually he co-authored the Bible on valuation. I'm sure many of you on this call have had to have read it and bought that expensive textbook during your MBA program. Professor Wessels not only teaches on the West Coast and East Coast campuses, he also is one of the faculty members for the executive training programs for multiple Fortune 500 companies, including McKinsey, where he got started. So Professor Wessels, thank you for joining us and for moderating this session.
Yeah, my pleasure. Thanks everybody to taking a little bit of time out of your day and to return to the classroom yet again. I just give Adriana and her team a lot of credit for working hard to put this together. It's not easy. And so, Adriana, we really appreciate this because learning never stops. And this group especially loves to learn. And I'm part of that group as well. So I really look forward to our session today with Paul. Let's start with Paul's technical cred. Paul's right up my alley. His history is around accounting and specifically around earnings quality. And Paul, if I had my choice, we would spend the next hour talking about the ins and outs of how people really get you by let's say consolidating a joint venture very quietly to boost EBITDA right before an acquisition. But we won't get into all those details, Paul, which you built your career around. It's more about your career today, which is leading the global practice for Alvarez and Marsal around transaction services. And what that means for Paul is he's traveling the world talking to limited partners, private equity specialists, companies, really trying to set strategy for his group and get a good understanding of the landscape. So it's exciting to be able to hear from someone who's on the cutting edge on a global basis around private equity. I think we all learn a lot from that. And so, Paul, the way I'd love to start today's conversation is a little bit about you, a little bit about Alvarez, because I'm not sure everybody will know Alvarez, and a little bit about the Transaction Services Group, because again, it's a huge group, and if you're involved with it, you might know a lot about it, but I'm not sure everybody will. So tell us a little bit about, Paul, about your personal story before the Alvarez days. How did you get where you were at? Like, what's your passionate around, and how you've built that into the current role that you're in?
Sure. Well, first of all, let me start by saying, number one, I'm in the same camp as all of you, is wanting to always continually learn. And that's why I like to surround myself with people like this. So thank you for having me. It's a great opportunity for me as well. Adriana, I did not know this was the first event that you've done. So I'm glad that the bar is set very low, because that's been one of the set the bar low and then exceed the expectation. So I'm gonna live up to that today. So thank you. So by way of background, I'm actually here in the Alvarez and Marsal, or A&M office in New York City. My whole career has been spent in New York. If you can't tell, I'm kind of typical New Yorker with the hands and all that. I have a degree and a background in accounting. I'm actually a U.S. trained CPA. And after college, I had interned when I was at university at Arthur Andersen and started my career there post graduation. And in those days, private equity really didn't exist as a service. Transaction services didn't exist. They actually didn't even call it private equity. Then it was called financial buyers when it started to come on the scene. And I started my career in audit, like pretty much everybody else, not knowing that that's exactly what I wanted to do, but it was the early 90s, and it was just good to have a job. So I knew accounting, not that I loved accounting, but I knew I would get a job. And I probably audited, which is probably the coolest thing you can audit. I actually used to audit the National Football League, which is amazing. Actually, people don't know this, but the NFL is actually a nonprofit organization because everything is taxed down at the team level. But I used to audit the NFL, and I used to audit the Super Bowl every year. So that was about as cool as auditing can get. But despite all that, when private equity started to come on the scene, and people needed transactional due diligence, quality of earnings, financial and accounting due diligence, the way the accounting firms approached that was, whatever audit division had the industry expertise, that's where the deals would go. And I worked in commercial products and services. So my background from an industry perspective, I'm what you would consider a generalist. I can handle deals in, things that do not require specialized accounting expertise. So manufacturing, distribution, retail, restaurants, those type of things, right? When you get to the real specialized or regulated industries, financial services, real estate, software and technology, healthcare, we have people that's all they do. You can't dabble there. You got to live and die in that. Mm-hmm. So, I saw people running around the firm, and it was mostly senior level work, partners and whatnot. And I said, I was like a senior associate. So what are those guys? What are they doing over there? And people are like, well, they're doing deals. And I'm like, deals? I didn't even know what that was, but it sounded good. So I literally knocked on someone's door and I said, hey, you don't know me, but I'd love to start doing deals. This was like the mid 90s. I landed up going into what they called the Financial Buyers Initiative. Me and maybe 20 of us at Arthur Andersen. And then for what you may know or not know about M&A, that kind of took off up until the dot-com boom in 2000. And then in 2002, when Arthur Andersen collapsed under Enron, I went with my team over to EY. So I ran EY's. I was a partner at EY before I joined A&M 18 years ago, and I ran EY's New York middle market private equity practice. And then Alvarez and Marsal came calling. And I joined Alvarez and Marsal almost 18 years ago to start and co-found our global private equity services practice, which is where I am today. So, my background, roughly 30-year career, 25 of which serving private equity, half roughly in the Big Four, half at a global professional services firm, which is more broad than an accounting firm at A&M. And I think I said this earlier, I probably worked on personally about 1,000 transactions in my career. And it's almost exclusively private equity and private equity portfolio companies.
Paul, can you tell us a little bit about the Alvarez story? It's about 20 years ago, I worked with Alvarez professionally. So it's been 20 years it's probably been 25 years since I've worked with them professionally. But back in the day, I just remember Alvarez as being like this scrappy upstart, like that was trying to dethrone the PwCs of the world. No one really knew about it. For some reason, I have Chicago in my mind. And today Alvarez is so much larger. Can you tell us the Alvarez story? How did they break in to this really sort of consolidated market already?
It's kind of, someone's going to write a book at this firm at some point because it really is an incredible story. So the firm is 40 years old. We're celebrating our 40th anniversary. It was founded in 1983 by Tony Alvarez and Brian Marsal, two people and an executive assistant. In the history of A&M in 40 years, we've never bought a company. And today, fast forward, our year to end just ended in October. We have almost 9,000 professionals in 80 offices around the world doing, $3.5 billion of revenue. Privately held. We have no debt. We have no outside shareholders. We will never go public. What we do is we focus on serving clients. And the history and the foundation of the firm, Tony Alvarez and Brian Marsal both have a restructuring, turnaround, bankruptcy angle. And Tony Alvarez was a young partner at Coopers & Lybrand, and Brian Marsal was a workout banker at Citibank. And essentially they came together and created really a business around saving troubled companies or exiting them out of bankruptcy. So, I met them because they actually were involved in the liquidation of Arthur Andersen. So there's a lot of ex-Arthur Andersen people that work at Alvarez and Marsal now. But if you haven't heard of the firm, the big claim to fame is Lehman Brothers. We led and worked on the Lehman Brothers bankruptcy, which was the largest bankruptcy ever, we'll probably ever see. And if you look at where we are today on the restructuring, I think we're in something like 7 of the top 10 largest bankruptcies. We're doing FTX,
Right.
we're doing Silicon Valley Bank, WeWork, Rite Aid, Revlon, it's all public. I can mention that. So the firm by far is the world's largest restructuring, turnaround, and crisis management firm. But it has grown over the last 20 years to a much broader global professional services firm with a market-leading M&A private equity business where I co-lead, as well as a corporate focus. We work with the Fortune 500, doing everything, either a professional services firm would do, except audits. We deliberately do not do audit work. We don't want to get caught up in Sarbanes-Oxley or SEC registration type work. So as a result, we do everything that basically every competitor out there can do without independence, conflict, restrictions, and then we can do a whole lot more.
Yeah.
So,
you have the size now. I mean,
have the size. Yeah.
Like I said, and I, if I rack the brain 25 years ago, I will admit I was in the midst of a crisis with Alvarez. It wasn't a personal crisis, but it was a company crisis I was dealing with. And so that's how I got to meet the restructuring folks at Alvarez. And boy, that's a specialty field in itself, right? There are certain levers that you can pull. So no question the company has just a stellar reputation in that space. And it's interesting to see it branch out now, far beyond the restructuring.
Yeah, it's kind of amazing. The last thing I'll say, so getting into M&A and private equity is obviously a great business in and of itself, but it's also counter-cyclical to the restructuring business. So there was a strategic reason why we went into that. And the group that I lead today, we have over 1,000 ex-Big Four CPAs or chartered accountants in over 40 of A&M's offices, and it's one of the largest practices in our firm. So in that role, that's where I spend my time, traveling the world, meeting with clients, getting firsthand boots on the ground knowledge. But the last thing I'll add that I think makes A&M unique, and it's relevant for this conversation, we actually have an affiliate private equity fund called Alvarez and Marsal Capital Partners, which I believe has 4.2 billion AUM across 4 different fund strategies. So in addition, I work in the consulting firm, but we have an affiliate fund that invests not just our partners' money, but also independent third-party LP money. And I work with them a lot as well in serving them and executing their strategy. So that part of my knowledge of private equity is also, being an investor, but also an advisor to our own fund.
Right. I'll have to give some thought about the alignments on that one later. I might have to do a little bit of research. I'm sure it's all double down on alignment there.
No, trust me, it's very, we're very strict with our general counsel. We've been doing it for, I think we started that family of funds over 12 years ago. So there's a history there.
Well, I can tell you if you're putting into, money into deals that you want to see those deals get better, it's certainly an incentive of alignment to have some of your own skin in the game. So I get it.
That is a good point. And that's part of what we do.
Yeah. All right. So what I would love to talk about for the next, let's say 20 or so minutes is let's take a typical, private equity transaction, starting from the very beginning to the end, and just talk about trends that you're seeing in the industries. So for instance, the first thing that I think makes or breaks private equity, both venture capital as well as LBOs, is pipeline. Flow of pipeline coming in. You can do all the great due diligence on the back end and extract the synergies. If you're not seeing good deals, none of this gets started. And so maybe you could just talk a little bit about today about sort of, where are areas of interest for private equity firms? How are they generating that pipeline? What industries are attractive? What countries are attractive? Like, what are you seeing today as far as just this deal identification?
Great question. So that's actually very relevant today. So private equity has really evolved over the last 20 years or so to a much more mature asset class. In the olden days, I used to joke around, everybody's money's the same color. Everybody was a generalist firm. And, what has happened over time because of competition, the number of private equity funds, the sheer number of them has quadrupled, right? Plus add LPs that now do direct investing. And so there's family offices, the sovereign wealth funds. We're seeing all of that, traffic in the market. So in order to compete, there's what we call the barbell effect, right? You're seeing either one subset of funds get, just by sheer size and volume, because they're so large, they're just naturally going to see every deal in the market, right? And then what you have on the other side of the barbell are very niche, specialized firms that maybe focus on nothing but one industry, but they are extremely deep. So think about that. You would do a deal with these folks on one end of the barbell because they're so large and have access to capital and expertise and all that, or the other side because they're so industry specific for you that they're going to add value. The folks in the middle have gotten squeezed. Now, where they find those deals, this is what has rapidly changed. So technology and AI is really moving that part of the market. Up until recently, it's interesting, most of these private equity funds, when you talk to their business development people or whatnot, say, how do you find deals? They have a general strategy, but most of them are managing a pipeline on literally Excel, or they have a bunch of operating partners that know people in the industry and they just all around. Well, data and data analytics has changed all that and made it much more targeted and efficient. The market has become extremely efficient. We started a product at A&M called DIG, for Data Intelligence Gateway, and we have developed proprietary technology that uses publicly available data to drive private company insights. And we started doing that about 2 or 3 years ago, and we were kind of one of the only people. And now there's so many people that are doing the same thing. It's tough to differentiate. But data and data driving is really driving deal identification in a big way.
Yeah, this is definitely one thing where large language models can make a difference, right? Sifting through English. Just to give you a funny story, when I started in venture capital back in the early 90s, when it was still just a little nascent business, there were only a handful of firms out there. And basically the partner gave me a phone book and said, go find some deals. I mean, we didn't have an internet. There was no web. This is all pre to that. I mean, you just basically got on the road and talked to people and looked in a phone book. Today, I mean, with scraping, I mean, and the web out there, you can create your own database of thousands upon thousands of privately held companies, what they're doing. But we could never do that even 5 years ago, probably.
No, I would say it only started about 2 to 3 years ago.
Yeah.
With open source intelligence, machine learning, it's really pretty wild. And then you can overlay so much other data on top of that. You can overlay geographic data, weather, traffic patterns. I mean, it's really wild. So the market is really headed in that direction from a deal identification. But some of the olden things still are there, like industry focus. People have in the commercial diligence around industries. Some industries that, in my view, are never really impacted by economic cycles are like healthcare. There's always M&A activity around healthcare, and I'm not a healthcare expert, but healthcare and all the sub industries in there. I just look at the business that we have, very large, one of our strongest industries. The level of transaction activity, it's like we can't hire enough people to serve that part of the market. Adriana, you're in that part, but there seems to be, regardless whether we're in a boom M&A cycle or a down M&A cycle, there's a lot of healthcare activity. Software and technology was carrying the M&A market for a long time. When interest rates went up, that has slowed significantly. So we've seen a slowdown there. There's been more of a flight to quality, particularly around brick and mortar type things that are less risky. So you've seen, dynamic changes around that type of stuff, but there are fundamental things that are still driving M&A today. I think if you understand the economic environment, as I'm sure most people here do, between interest rates, inflation, geopolitical risk, a lot of the larger deals have gone away, and you're seeing a lot more activity in the upper middle and lower middle market. Less debt, you could over equitize the deals. Then you got, obviously private credit out there, which is a hot thing you read a lot about today. People are getting very creative in order to trade smaller deals, more focused. I think 70% of all add-on activity, of all private equity deal activity last year was add-on activity, not platform. So smaller deals, tuck-ins, get the synergies, get the buy-in multiple down. And
Paul, you talked about this barbell effect. I'm wondering if the technology trends that we've seen over the last few years are just going to amplify it further. Because if I'm a handful of partners with a couple associates, can I really get into machine learning and AI algorithms to do deal sourcing? I barely have the bandwidth just to do traditional due diligence and handle the meetings I'm handling. I almost need one of these large firms with a huge infrastructure and even a IT group that's 30 people to be able to bring this in. And sort of makes me wonder, will the rich get even richer? Because we're seeing that in venture, right? It's so easy for Sequoia to raise capital and to win deals because they're so large, they've got that scale. Right. Is the same thing happening? Then is it even further? Can that right side of the barbell even exist? with that niche, because I get what you're saying. Like, hey, if I really know a very minor space, and let's say healthcare, mobile platforms, but
Yeah.
will those guys even get wiped out just because they even might need the scale
Maybe,
to
maybe.
compete?
You see like the Blackstones of the world, looking to get to $1 trillion of AUM, right? And it's not a private equity firm anymore. It's a global asset manager, right?
Yeah.
Real estate and all the type of things. So that's the big side of the barbell. And then you see a lot of these smaller niche funds, on the other side. We'll see. I think you raise a good point. We'll see where it goes.
Yeah. And you also mentioned just the increasing competition in the PE space. Do you think the returns will be there over the next 10 or 20 years? I mean, no one can predict the future, but
No,
we got all these people chasing all these deals with all these big checks.
No, my personal view is, it's like anything else, as a mature asset or more mature asset class, the returns are going to come down. They're not going to be like they were. I think if you think about it, the last couple of years, right? It's been the heyday of M&A. So people have bought at very high multiples, right? 15, 16, 18, 20, depending on the industry, right? You look at where we are today. Now, a typical private equity fund has a 10-year life. First 5 years, you're investing the capital. The next 5 years, you're harvesting that capital. At the end of 10 years, you're returning it back to the LPs, right? Well, number one, the holding period of portfolio companies is gone to a record. I think it's about 5.8 years. And they say people anticipate going to 7 or 8 years before they exit. The reason for that is because effectuating the value creation strategy is taking longer. Okay? Because think about what happens. Over the last couple of years, you've bought these companies at very high multiples. Okay? It is highly likely that if everything stays static, that when you exit that company, the multiple is going to be something less than what you bought it at, just given where the market is today versus where it was the last X many number of years. Yeah. So the first thing you need to do in order to generate returns is make up for that multiple contraction upon exit. Okay. Then with a poor economic climate, you gotta make that up too. If the business has some issues, whether it be supply chain, inflation, commodity pricing, whatever, then you got to add value on top of that. Okay. So from that perspective, that's a tough order. It takes longer. You're seeing people raise continuation funds. You're seeing people raise long dated funds. But what's interesting, and this is the point I wanted to make, people are looking for ways to create value where they couldn't before. Okay. So, a lot of it used to be financial engineering or just simple cost takeout or revenue enhancement. Things that we're seeing, two big areas where we're seeing where you wouldn't think. Number one is digital. We have a group at A&M that does digital transformation, and essentially every company needs a digital strategy. And there's ways to extract value. Like if you're selling to customers off a website, are you capturing that customer data? How are you managing that? Like traditional didn't do that. And what's really interesting, ESG, believe it or not, which is a group I actually lead in the US at A&M as well. Institutional Investor, the magazine, did a study and said 80% of potential buyers would pay a higher multiple on a business with an improved ESG score. So so we do ESG at A&M, but we don't do it from a check the box compliance perspective. We do it from a value creation perspective. And we put that in our tool set with everything else we do, the traditional stuff. But you're seeing a lot more value creation being driven by digital and ESG, which is really.
I think I would love to hear more about the digital. You're right. Historically speaking, go back 25 years, and private equity was around, a manufacturing firm in the Midwest, and we bring Six Sigma in, sort of clean up the bottlenecks, have them renegotiate with suppliers, add some financial leverage to boost the returns. That was the strategy of the 90s, 80s and 90s. Today, you're right. I could easily see, the new strategy being, okay, we're not manufacturers anymore. It's a digital world. Like you said, capturing customer data. Are we using it appropriately? That could be a huge synergy for the organization. And that also, I was thinking, well, this is late in the process because it's about executing on synergies. But that also defines your strategy, right? Because you're looking at firms that, don't have a very good digital presence, but have a great suite of products. Where the benefit is largest. So can you talk a little bit more about how PE is using digital to extract synergies, and what are some other things besides digital that PE firms should be thinking about or are thinking about to like bring their, as you said, their own expertise in?
Listen, I'm going to be completely honest. I am not a high-tech digital expert, okay?
But
we have a large team at A&M that I bring in and have introduced to my clients and worked alongside of. But what they've taught me was that, as you described it with these old line manufacturing businesses, the majority of companies today do not have a digital strategy. It wasn't something that they were focused on. So, what I do is when I go in and I talk to my clients and I say, how can we be helpful? One of the questions I ask is, what's your digital strategy? And they're like, what do you mean? And I'm like, well, what are you doing around digital with this business in order to create value? And they don't even know what they want, but they know they want. And they're like, hey, we need to talk to your experts on that. And then I'll bring our folks in. I would say digital is clearly, we've invested heavily as a firm globally in a digital transformation business. And, we're not doing that just with private equity. We actually do a lot of assignments in corporates as well.
Absolutely.
So there's a lot of opportunity there for value creation across the entire digital landscape.
Yeah, and I'm working with some of the largest consumer products firms in the world who have deep expertise in digital, have literally 1,000 people potentially working in digital, and even they would admit it's nascent for them. Like they're still learning sort of the right questions to ask, and they're still putting their groups together. So if this is the P&Gs of the world that are trying to figure this out, you can only imagine that again, I'm a mid-market company. My corporate staff is 30 people. My IT group is like 9. Digital strategy, we have a website, right?
I know, right, exactly. Well, it's interesting because even at A&M, I see it internally. You're starting to see convergence, right? So we started a couple of years ago that data intelligence gateway business, as I mentioned, right? The deal identification, right? We also have a global transaction analytics business that does data analytics around deals, right? Big data type of stuff. And then we also have a separate digital transformation business. And what's happening now, they're all converging, particularly with AI and ChatGPT and all that. We actually created a tool which we're rolling out called Diligence GPT, because that's going to, the diligence industry, whether it be legal or what I do, is clearly ripe for digitization and AI and all that. So we're working to bring that on deals as well.
Right. Okay. So let's move on to due diligence.
Yep.
Clearly, digital plays a role, and we could talk about the importance of supporting digital. But Paul, this is also your area of expertise, going back 25 years. And I have to admit, the geeky side of me wants to learn a little bit about the kinds of stuff you're working on. So let's say I am a private equity player. I'm relatively sophisticated, but still could always use a little bit of help. From a due diligence perspective, what are the traps that people still continually fall into, that your team spends most of its time thinking about, so that we can sort of have a checklist in our minds that when we're going to go in, and purchase this company, we don't fall into yet the same traps that, 200 of your clients have fallen into without your help?
It's hard to generalize it like that. I think when you look at big traps, it's a lot of industry focus. But what we try to do is when we, so our typical process works, we cover X many number of private equity clients where we're sort of the primary provider of their pre-acquisition due diligence work, right? I think last year at A&M globally, we worked on over 3,300 transactions with over 500 different sponsors, right? And we typically get a call when they've identified a deal, and they may have it under LOI and whatnot, and it's like, okay, we're in the second round, we like the asset, we want to do some confirmatory diligence, and we'll phase the work until they know they really have the deal, and we'll have 90 days to do it and all that type of stuff. So that's the typical process. One of the things we're seeing now is we're actually being brought in earlier in the process. So we've had clients who call us up and they say, listen, we don't have a deal, but we're thinking about a thesis in a particular industry, and we've hired an MBB or somebody else to come in and help us validate that thesis, right? And then what A&M does, we pride ourselves not just on having consultants, but we have real operators, several thousand people that have actually run businesses. So healthcare being one of our strongest industries, we have doctors, dentists, and nurses, right? So if I have a client that's doing a deal, they're rolling up a chain of teeth whitening clinics, I'm going to bring a dentist onto my financial deal team. And he's like, hey, when I was running my practice, here are the things you need to look out for. So that's where you're seeing much earlier discussion with more operational type folks earlier on to kind of vet an industry. And then they start the search once they have a thesis. Okay. So we're seeing that. Now, once you're in the deal, okay, where we get that call and, the data room's open and we're kind of running and gunning, what we try to do is focus on giving clients, this is going to sound weird, but it's not giving clients necessarily what they want. It's giving clients what we think they need, right?
Okay.
So the client will say, hey, we want this, this, and this, and this is our thesis here. And you say, okay, well, what are you trying to achieve? And they're like, well, we want to see, okay, well, if you want to see it, this is what you're asking me for, I can give you, but that's not going to get you there. You need to have this. But I think it's when you get into the data room and when you get, into the diligence, the key thing that we try to do is understand what, from the client's perspective, right? Because the private equity folks, listen, they're in the business of doing this, right? They get paid to take these risks. They have the investment thesis, but I tell our people, we need to think like them. So you ask the private equity client, you say, listen, what are the key three, value drivers or risks and opportunities here in this deal for you? And that's where, I don't want to have a group of consultants or advisors like me focus on things up here where the client really cares about things up here, right? That's where you have a disconnect. And that's where a lot of the risk sometimes happens. But there's so many other things. Like, I can't tell you how many times I get a call, hey, Paul, we're looking at a new deal, but it's a public company and it's audited by a Big Four firm, so it should be pretty clean. It's like, well, let's take a step back there. Have you read the Financial Times lately? I don't know if that's necessarily a valid assertion, right? So, that keeps us in business doing your diligence. So, listen, I know I'm not getting too specific because it's just too general of a question.
Yeah.
You'd have to really dig, but there are certain industries that lend themselves to riskier. I could tell you like when clients telling me, family owned business, never been audited. They use percentage of completion accounting, anything that's subject to estimates, that can be manipulated. And then sometimes there's just innocent errors where other times there's actual, fraud, right? And I've seen both over the years. I have some crazy stories I can share.
Yeah.
I actually want to interject here because along with clients, these PE shops looking for A&M, they're actually also reaching out to headhunters or operators who will create the investment thesis for them, go out and find the company and then operate it, step in as the CEO and operate it with them. So this is something that I'm seeing a lot of. I've received at least 10 emails and this year from proper PE shops that you would think would have their own investment thesis. I want to go into this sector, this region, and they will look for individuals who can go and get these deals for them. And I was chatting to the audience. I was chatting earlier with Dave and Paul on this, and I have a search fund and I'm under LOI now, but it is amazing to see even in the search fund space in the lower middle market, how proper PE shops are going down to searcher deals. So they're really trying to create value for their platform companies, and these add-ons, these tuck-ins that Paul mentioned are actually, the way that they're going to create value for their investors, because the holding periods are going to be longer. It's not just putting in the proper capital structure anymore. So I kind of wanted to tell you that.
David, the one thing I'll add to answer your question, last thing I would say it's important. If you ask, because I've done this, I ask my private equity clients, where they've had missteps, where the number one recurring theme is around the management team, believe it or not. They don't have it. Sometimes I've had clients tell me, we've worked with this management team before. We're actually, we're not as in love with the business, but we love the management team and we know whatever they do is going to be successful. But when things don't go well on a deal, like right out of the box after they buy a company, their biggest mistake is not changing out that management team sooner. They wait. So I think focusing on management and the management team is also a key area of diligence on a lot of these deals.
Yeah, which unfortunately is a little harder to measure, right? It's a little bit more subjective.
Very
than market sizes and so on. What Adriana says is a great point. It's happening throughout PE. I specialize more in venture than I do in traditional LBOs. But again, the reason I come back to this one side of the barbell is, if you're thinking about what your strategy is as a Sequoia or a KKR or someone, you're going to have a set of specialties, and one of them might be headhunting, to fill out roles. One of them might be digital transformation, and so you have the leading experts from Accenture who used to work for Accenture and now run, quote, the digital strategies group at Carlyle, and can come in, I've got my Six Sigma group, and so it's almost like you're bringing this whole cadre of expertise that shoot into a company and can sort of, rebuild it from the ground up.
David, I'm laughing because I think in our digital transformation group, we have something like 27 partners who came out of Accenture.
Yeah, yeah, exactly. I mean, they got the early jump on it. Anything else you can think of from a due diligence perspective? Again, management team, I completely understand, but just other pitfalls. And again, if you want to pick an industry like healthcare or manufacturing or anything, that'd be fine. Percentage of completion I put up here. For those of you who don't know, right, percentage of completion is subject to estimates, and so you can be really frothy right before you do a sale, and everything looks great, and then you go back and look at the real numbers on sort of where you are on big projects and
long-term contracts, percentage of completion, the whole area of inventory and inventory accounting, obsolescence, cost of sales.
Okay.
You know, that's always ripe with risk, particularly in a manufacturing or distribution environment. You know, there's all types of things. Like I said, it's deal and transaction specific, but even countries in which they operate in, certain countries are higher risk than others. Supply chain is a big risk right now for obvious reasons. You know, you see what's happening. We're seeing a lot of clients move their supply chain out of China, or at least have a dual strategy where they're moving it more to Southeast Asia or India.
Yeah.
I mean, you know, there's a lot, but what we do, you know, our approach is very integrated and very holistic, right? So we're not just focused, you know, I'm focused on the finance and accounting side, but we have obviously folks in tax and then any cadre of operational you can think from IT,
Right.
HR, you know, all of that stuff. So you got to come at it from a lot of different angles.
Right. We talked a little bit about identification, due diligence. We've even covered, you know, execution on these synergies indirectly through digital transformations. How about exits? You know, you've already given me a little bit on your thought on exits, because I have to admit, I always get a little frustrating. You know, I was back in the banking days. I obviously was part of the gloating team, but I was always a little frustrated when people celebrated the purchase. Because if I'm an LP, I want to celebrate the sale. So we usually have the purchase parties, and I'm like, guys, let's get to the sale first. We're celebrating a little bit early. And you know, obviously the exit environment's always been tough because, you know, buying these companies is easy. The question is, you know, where are you going to put it eventually? You're either going to put it into the public markets, if the markets will take it. You're going to put it in the hands of a strategic buyer, if one is out there, or just as likely, and this was always a little bit of frustration for me as an academic, you put it in the hands of yet another PE shop, right? And so it just sort of does this circle of PE shops, which I always found to be a little bit, you know, strange. But exits today, what are the trends that you're seeing, you know, on getting liquidity for these investments that have been out there for a while?
Very interesting. So, you know, if you look at the private equity market, I think the latest count is there's roughly 2 trillion of dry powder or capital that's out there that's been raised that has yet to be deployed. So there's a huge backup of buy side activity, right? Part of that is driven by the backup of sell side or exit activity, right? You know, when you had a market, this is what I've learned over 25 plus years and seeing multiple cycles. The markets, whether they be the public equity markets or the M&A markets, they do not like uncertainty, okay? And right now, we have a lot of uncertainty around interest rates, around geopolitical. In the US, you know, we have an election year next year, right? I can tell you every election year, the M&A market is choppy until they know, and, you know, between the two political parties, there's vastly different approaches, right? To the economy, to fiscal and monetary policy. So I would almost say that it doesn't matter what direction things head in, as long as there's some level of certainty. Is the Fed done cutting? Is the Fed done raising rates, right? Because then the market will adjust to the new normal, right? I mean, a lot of people on this call probably don't remember this, but I bought my first house in 2000, and I had a 30-year mortgage at 8.75, and I was thrilled. You got that today. You know, people don't remember those high interest rate environments, right? True. So, but deals were getting done then, right? They were getting done at 7 times, right? So I think what has to happen, there needs to be some certainty. But what I like about the private equity market is they are obviously in the business of doing deals. So people have to buy, people have to sell. We just need some time for there to be certainty in the markets so that sellers and buyers adjust their expectations of value, and then it starts to go. And then the financing comes back and all that type of stuff. But, you know, we have, I think, one of the largest sell-side due diligence practices in the United States. We work with a lot of the investment banks from Jefferies, Moelis, all those type of folks. And I'm seeing an uptick in sell-side due diligence, which is usually a good 3-month window to things coming to market. But they're having us get the assets ready for sale, not knowing when they're going to launch. And every month we keep updating the analysis. So we've been updating some analyses for 12 months. I'm like, this is the longest project, but we're ready, and I don't mind. I mean, we get paid for it. So we do that. But what we're seeing, here's the other challenge. The other challenge are the LPs wanting their return of capital, okay, from these GPs, from the private equity funds themselves. And what they're saying is, hey, if you used to give us 200 million back in a year, and we would then commit another 100 million back to you for your next fund. If you're not going to give me that 200, or you're going to give me something significantly less, I'm going to commit significantly less back to you. So now the funds, the GPs, are coming up with creative ways to get liquidity, whether it be secondary sales or things like that. One of the most recent trends, and I haven't seen this with any of my clients, but I've read about it, is, you got these portfolio companies that are already levered, right? They're taking out, net asset value loans on the value of the entire portfolio, and then using that cash to pay LPs. Personally, I don't think that's going to end well. You're leveraging on top of businesses that are already leveraged. So I worry about that. And my personal view, I'm probably a little bit more bearish on the economy than others. Although I do believe, as we look at 24, all the things we know, inflation, interest rates, geopolitics, we know all that, right? I think you have the election, which is going to be choppy. My personal view, though, I think for political reasons, I think probably around the second quarter, you're going to see the Fed start to lower rates to try to juice the economy headed into the November election in the US.
Yeah.
Political reasons.
And I agree with you on the election being super important, because I don't think we've seen such an active DOJ and other branches of the government that are scrutinizing these M&As in almost 30 years.
Well, that's another great point. CFIUS, right, which was the Committee for Foreign Investment in the U.S.
Yeah,
it has such teeth right now that every transaction, whether it's risky or not, just gets hung up in a period of time. So that's created a little bit of a chill in the market. Now, there's some valid reasons for that, right? I understand we want to protect certain proprietary national assets, but it seems like it's way overreaching right now. A lot of government intervention.
Yeah, we're just seeing more of it. I mean, it was almost like it was completely hands off for 30 years. You saw tremendous antitrust in the 70s and early 80s, and then ever since Reagan, it's just sort of, don't touch antitrust. And now it's made a comeback under the current administration. But if you've got an election that's 50-50, that could go away overnight, or it could double down with another 4 years. So I can see that uncertainty. If I'm a major buyer, a strategic buyer, I might just want to sit it out, and because the last thing I need to do is get a deal hung up, a major deal hung up for a year.
Yeah, but it's interesting how elections drive M&A activity, because I remember a bunch of years ago when Obama was potentially getting reelected, and there was rumors that he was going to significantly increase taxes and whatnot. Okay. So it was a ton of M&A activity before the end of that calendar year to get ahead of his new, if you sell something in December, you're going to pay a lot less taxes. If you sell it in January, you'd be an idiot to sell it in January. Yeah. So we had tremendous, like the fourth quarter of that year, I remember it being like, we couldn't be busier, right? And then, it took its own, way through the system. But, it's interesting. But people underestimate the impact of elections. And then as the U.S. goes, a lot of the world tends to follow.
Yeah. You mentioned rising interest rates, which has been on the radar for 18 months. We haven't really seen the big high-profile disasters yet. You're not reading the Wall Street Journal about yet another private equity-backed, venture going bankrupt. Are we on the precipice of this? I mean, if interest rates stay high at 7% and we get to 2025 and 2026, when a lot of these private equity loans come due, will they be able to roll these things over? And if they, are they prepared to have, double the interest payments they currently have?
Well, to your latter point, I think the answer is no. I think what you're seeing today, after the financial crisis, right, in 2008, 2009, it took a period of time, but financing went back to almost the olden ways with covenant light loans and, very weak, restrictions and covenants and whatnot. So, people were able to kick the can down the road for a period of time. And I think that's why we're not seeing as many as we are today. I also think there's so much capital out there that, companies, are able to get rescue financing without having to file bankruptcy, because there's somebody who's going to come in to look for that opportunity, right? So because of the capital in the system and the lending, criteria over the last couple of years, it's delayed a lot of this. And I think people are hopeful that by the time they may come due. The economy's in a different place, interest rates are in a different place, and they'll figure it out. I mean, I think it was somebody at might have been Jonathan Gray at Blackstone said, purchase price is finite, but financing is not. Oh, I'm sorry, purchase price is permanent, financing is temporary. That's what he said. And that, makes a lot of sense. So they gotta do something. So they're rolling the dice on the financing.
I do agree with you. I mean, there's a big difference between companies that get trashed because of a bad economy versus companies that get trashed because they have taken on too much leverage. If it's the bad economy, no one wants to touch you, right? If a company can't survive a bad economy, who's going to invest in that? If it's just about bad financing because they overextended themselves, that just means there's going to be some very upset limited partners as they find their equity positions in those companies wiped out. But you're right, the 2 billion of dry powder will be happy to step in, but at new calibrated rates that are more appropriate for a 7% or a 12% versus a 3 versus a 7.
So I'm very bullish on the industry of private equity in general, right? Because there's so much dry powder and you have to transact. I just don't know when the expectations are going to reset and folks will adjust to whatever that new normal is. The other thing, you would say one last thing, David. Yeah. You had also mentioned about global trends. One of the things that people tend to overlook are currency fluctuations. That actually drives M&A activity, whether it be inbound or outbound into a country. So I was in Japan about a month ago, and the yen is extremely weak against the dollar. And of course, they are anticipating a lot of inbound activity. If you have a local currency that's weak, it's essentially a sale, right?
Yeah.
Things are more expensive in other parts of the world. We saw this in Brazil years ago. So I actually monitor currency fluctuations because as I'm running a global business, I'm trying to follow and chase where the investment dollars are coming and going from.
Yeah, the only thing you have to be careful about, Paul, not for Japan or Brazil perhaps, but for a lot of countries, can you get your money out? Getting your money is incredibly easy going in, but again, I'm working with a number of clients where right now what we're looking at is incredibly creative ways of getting money out of a country because you just can't get the currency out. Now, do you get products and services out? What do you trade? So for, especially for emerging markets, this becomes a huge issue.
Yeah, we have that. We deal with that in China. We have a large practice in China. We deal with
a good example right there. All right, one more question about just trends we're seeing. And we've talked about this a little bit already, but historically speaking, it was the old middle market, like I said, Midwest manufacturing firm. Now private equity is all over tech. It's all over healthcare. How have those changes changed your job? Again, a manufacturing firm, as you said, pretty easy. A lot of the technology and healthcare companies, a lot more complex to deal with. I mean, running a healthcare company is not easy, given especially the regulatory environment. How's that changed? And do you think private equity can survive this?
That's a great question. So when I look at our practice, I would say 50% of our practice are generalists, people like me, right? The other 50% are industry expert teams, right? The healthcare, the FIG, the software and technology, energy and infrastructure, those type of businesses, right? And we have a policy when deals come in. No matter who you are, if you get a deal in the healthcare space, you have to pass that off to our healthcare team. I don't want people dabbling who aren't healthcare. I would struggle on a healthcare deal, right? I'm a brick and mortar type of person. So it used to be easy to determine. A deal comes in, oh, this is a software technology deal. This is a financial services deal. This is a healthcare deal. And it would go to those teams. Now, when deals come in, we struggle to say, wait, is this tech? Is this healthcare? Is it fintech? We struggle. And what I'm landing up doing is I'm putting multiple teams of industry experts on the same deal. So I have healthcare and technology people working together. I have financial. I'm actually in the process of beefing up our fintech team, which is an area that, a subsegment of our FIG business we're not as strong in, but I'm adding people in that. So that's where I'm actually seeing the convergence, tech, financial services, healthcare, these industries are kind of coming together. And then to your point, I do think these private equity funds need to diversify a little bit to make sure they can handle those type of deals with all that different expertise.
Well, I'm going to ask you two last questions and I'll turn it over to Adriana. I'm just trying to picture the different kinds of people I've worked with that are likely on this phone call. Imagine that I'm an executive and I've just been told that my company's been bought out by a private equity shop. And I'm a C-suite level executive, right? So I'm very, very senior. If I want to work for a private equity shop, even in my current job, or let's say I'm about to take on a CEO role in a private equity backed firm, what's the one piece of advice you would give this operator if they've never worked with PE before, or their experiences with PE has been limited?
I think it's clear you're on the same team. You have to understand the expectations. Make sure you understand the expectations. When things go wrong, I find there's a misalignment of interests between the management team and the financial sponsor. Okay. Alignment of interest is key. Not just in strategy, but financial alignment. I mean, listen, we know compensation drives behavior. So you work backwards. What's the behavior you want from your management team, and then align the compensation to drive that, right? So you want everyone rowing in the same direction. So I would say understand the expectations of your new owner and make sure everyone's interests are aligned between them, all stakeholders, whether it be the management team, the sponsor, and whoever else is in there. That would be.
Yeah, I have to say, a lot of companies, when you're working for a company, what I like to call play to play, right? It's from an old A.G. Lafley term. This idea that, you're working for a P&G and you're just out there playing the game, filling the quarterly reports. When you're in private equity, it's almost like a race. Those guys are playing to win. And so you almost have to reset your attitude to a little bit more of a killer mentality.
Yeah, and recognize that, they're not in it necessarily for the long term, right? There will be an exit. There will be an exit.
And if you were to give some advice to an aspiring PE shop, so let's say you have someone because we could have this on the phone call, someone who's working for a sovereign wealth fund, and they've just been tapped to head up a new PE group within that sovereign wealth fund. What advice would you give to them?
I think that's a great opportunity. I mean, despite the asset class having grown so big and mature, it's just what I like about serving the industry, even as a consultant. There's such a variety. You see so many different deals, you meet so many different people. My advice would be, there's almost no this is very much an apprenticeship model, right? You can go to all the school you want, but at the end of the day, a lot of the things we do are not textbook. Right? It's hard to explain that, but the schooling and the education will give you the foundation to build off of, to know what to do. But you need to have that apprenticeship model, right? We do that here at A&M. A lot of our competitors do the same thing. Private equity does the same thing. So my advice is, if you're a young person and you have this great opportunity to go on the buy side with private equity, I would just be like a sponge, right? Positive attitude, willingness to learn, take on things that you're not comfortable with, but you got to be there. I mean, I carried the bags for literally in those days, there were bags, right? And we didn't have laptops then. I was carrying bags, literally. But I was in the room with the management, and for a year, I just absorbed, right?
Great.
And then all of a sudden you start getting the cadence of things. So I think from a younger professional's perspective, it's positive attitude, willingness to learn, try to be in the room, do whatever you have to do, grit, perseverance for the long term. But I still think it's a great opportunity. You learn a lot, very interesting stuff.
Yeah. For me, the biggest question, just going back to, you're a new PE, jumping into the space. I know this sounds silly, but just getting back to what do the competitive dynamics look like over the next 10, 20 years? And what kind of scale do you need in order to be competitive in this space? I really do worry about that right side of the barbell. I totally get the niche play, right? You come in and you're convincing LPs and you're convincing, the companies that you're buying that you've got this deep expertise in this space. I just don't know if you're going to have the breadth of services that a Sequoia or a KKI can walk in with and say, look, I've got 15 former Hydrogen Struggles recruiters. I've got 13, former partners at Accenture doing digital. I've got just the scale game is so unfair today in this space, by a handful of players who can raise capital pretty easily.
Well, I think a perfect way of saying what you just said is, I said earlier, everybody's money's the same color, right? So why would you take money from one fund versus another? Why would someone invest with you when there's a plethora of capital versus somebody else? You have to give the businesses that you're buying a compelling why to choose you versus somebody else.
Yeah. Adriana, thoughts?
Well, I'm getting a lot of positive comments on the chat. Actually, it's the WhatsApp chat, unfortunately, instead of this chat, but on the dialogue and the insights that you both are sharing. So, we didn't touch on distressed assets. So what is that going to look like? I think that's an area both in venture capital and PE. There are opportunities in both spaces. And will you see, Paul, more shops outside of the traditional distressed assets getting into
Yeah.
some of these spaces, you know, is the Bains of the world, A&Ms of the world that are experts in turnaround, right? So do you expect more PE shops to get into this space?
So is the question,
Distressed
from an
asset.
yes, investing
Yeah.
in distressed assets?
Yes.
I don't know if I see I mean that's been an asset class that obviously goes in cycles, right? I don't know if I would say I'm seeing more or less folks. That's something where I always look at where fundraising activity is and what type of funds people are raising. So if you see people raising distressed funds, like, hey, they're anticipating like 2 years from now they want to be locked and loaded, right? But I don't know if I haven't seen anything different than historical trends currently that people are anticipating greater distressed asset deals or what. I haven't seen
And Paul, you gave us a list of the 10 earlier that Alvarez and Marsal is working with, but thank goodness we have some, because when I was building slides, I'm trying to convince my students that my young students, my 25-year-olds, that things do go bankrupt, but it's so hard to find examples. You go back 30 years and you just don't have it's amazing how much leverage we've taken on, how much risk we've had, and the default rates are still remarkably low, ridiculously low. So I'm trying to teach my students about risk, yet I don't have enough downside examples to like really hammer it home with them. I'm being serious. Everybody thinks ROE is an upside game only. But then again, we've had 30 years of lowering interest rates, rising equity markets. Like you've always had these, softening monetary policy. You've always had this stuff just bailing you out. Will we ever have those days where there's distress everywhere? I don't know.
Well, if I had to predict, I think one of the areas you're going to see a lot of distress is commercial real estate.
Yes, agreed. All right, agreed. Like
Hasn't happened yet, but it's coming. It's coming. That's coming.
So it's funny you mentioned that, because Professor Wessels, the last time I spoke to Paul, it was in regards to an opportunity that I had to join an organization very large organization by portfolio company by PE shop, healthcare company that was a divestiture of a very large company. And I remember I was just picking his brain. He tells me, the story doesn't add up. I told him I talked to the CEO. And then what was it, like 5 months later, 6 months later, I reached out to him like, look, they filed for Chapter 11.
Yeah. The downside risk is there. And maybe, Paul, we need to start a fund that converts commercial real estate into, yuppie condos.
Yeah, low income housing would be good.
All right, there you go. There's the next trend for people to look at. Because I agree with you completely. From a commercial standpoint, with work from home and all that, the trends look terrible. But people are still wanting to move into the cities, not for work, but for pleasure. And there's just not enough places to live, and certainly not enough new places to live. So a lot of these places could be converted.
Evidently, the math doesn't work out, though. It's cheaper to knock down the commercial real estate and rebuild, convert it to low income housing or any type of affordable housing or any type of housing.
Interesting.
Yeah.
We have some questions, guys, so I might want to make sure I get it in. For David, do you see VCs with dry powder looking to invest in startups and emerging economies with deep tech and product ecosystems, or investing as LPs with startup VCs in those geographies?
In emerging markets,
Mm-hmm.
Versus the traditional markets.
Mm-hmm. With deep tech and product ecosystems.
No, I know, boy.
Thinking like maybe Eastern Europe.
Yeah. I'm still a get richer kind of place. I think most of the stuff is happening in Austin, Texas, and Silicon Valley, and in Berlin. So the funny thing is, venture capitalists are remarkably risk averse, right? We think of venture as like taking all these we're looking for the 10x deals. I know we say that, but most of them would admit that they're a follow the trend kind of player. And then the question, of course, is, do they hit it right at the right time? So, there's going to be an AI company out there that's going to be a, $10 billion company. The question is, where is it likely to be sourced? It's most likely to be sourced in places where you have those ecosystems in place. So I have to admit, I don't know if there would be a lot of hunger for this kind of business in an emerging market. But Adriana, it depends on the emerging market, right? There's a lot of respect, for instance, in Ukraine for their technical skills, or in Israel and their technical skills. So I don't want to just say emerging markets. I think it really does depend. what kind of emerging market that we're talking about. If it's a hotbed of technology activity in a part of Brazil or Israel or Ukraine, that might be different than, let's say, a country within Africa where you're a standalone entity stumbling across a great idea.
Oh, that makes sense. In Latin America, we've seen a lot of unicorns come out of there in the fintech space.
Yeah.
It's a hot.
Well, and the other thing too, don't forget, I think where our next generation of entrepreneurs are, and I've seen this in my student body, is they see all the great things happening in Western Europe and the United States, and they're like, hey, I don't have this in my home country, right? And so they will literally take ideas that are very well vetted, customer propositions that are very well vetted, and then they will bring them back to their home countries, and absolutely those will get funded. The way I interpreted the question was, the next generation of, let's say, large language models coming out of a research lab in an emerging market. I don't know if you'll have the tentacles to really see that or trust it, which is very different than, of course, bringing American and European technologies into emerging markets. There's a huge hunger, and I think honestly that's where our next set of billionaires are going to be, in our student body. I don't necessarily think they're going to be in the Americas. I think they're going to be bringing great ideas from established markets to emerging markets, and then they become essentially a billionaire in their home country, the next generation.
This is great insights. And guys, we are out of time, and this was amazing. I got a lot of good comments. We didn't get to all the questions, some were comments as well, but I am so glad that we did this. Thank you, Paul. Thank you, Professor Wessels.
Thanks, guys.
Yeah, thank you. Appreciate it.
Thank you for everyone who joined us this afternoon.
Fantastic, guys. Good to see you all.
If people want to reach out on LinkedIn to me, I'm happy to chat further.